welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. We all want to build a good equity portfolio to optimize returns and create wealth. But how does one go about selecting from the plethora of options and the different funds which are out there? This week on Money, 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 personal finance expert Hemant Rustagi joins me to chalk out the right MF portfolio for different life stages and different age profiles. Thanks so much, sir, for joining us on the show today. It's great to have you on. So, here's the question. Almost everybody now is more or less convinced that the equity market is a route to create wealth. But the question is, how do you get onto the journey? What bus do you catch? At what point do you need to churn your portfolio? And where you really begin?
I think the first and foremost, I think every investor needs to realize what is the role equity has in the portfolio. If you talk about a particular asset class here, everyone knows that equity has the potential to build huge corpus for you. You get the best return, but not many people have the patience to go through whatever volatility comes on the way. So the problem is, if you decide that you want to invest for a long term, what are the long term goals? Depending on what stage of life you are, it could be to build a corpus for your child education, for marriage, or even for your retirement funding. The thing is that these are all long term goals. What they require is that you need to invest in an asset class like equity, which has the potential to give you high return, but there has to be some amount of discipline. The problem many investors have is whenever they're faced with volatility, they don't know what to do.
That's one problem. The other problem perhaps also is not knowing when you actually need to churn your portfolio, when you actually need to weed out funds that are perhaps not working or they're not in tune with your own goals. So let's start by breaking this down in life stages, because I guess a lot of the type of funds that you select will go as per your age profile, your risk appetite, your risk profile, etc. So if we start with someone who is a new earner, someone in their mid-20s to maybe early 30s, where does that person begin?
Well, I think we always talk about start investing early. Why do we say that? You're at a stage of your life, you're not earning serious money. You're a new investor, you're a beginner. You can afford to make mistake. Now, what it does for you is when you become a serious investor later on, you're not scared of equity. So what do you do when you look at, let's say, start building a corpus? Now, this is not the age where many people think about retirement planning. But the fact is that if you start putting aside some money, even if it is a few thousand rupees.
So do you have a thumb rule in mind? If you're looking at an annual income of, let's say, X, what percentage or proportion should perhaps go into an equity investment in this age bracket of 25 to 35?
Well, I would say, maybe around 15-20% at least to begin with.
Okay.
I think the fact is, like, if you start investing 15-20% of your money, it can help you build a corpus. And of course, important thing that you need to remember is that as you go along, you need to keep increasing that amount. It should not be that you begin with a few thousand and you continue with that. Sure. Important thing is, equity as an asset class is aggressive. Again, another mistake that investors make is they make their portfolio very aggressive. Why do they do that? Because, they look around, which are the funds in a bull market which are doing well. There are small cap funds, there are mid cap funds, there are sector funds, there are thematic funds. So they feel that since I'm coming into equity, why not go for the best? Best is not what you look at in terms of return, short-term return.
The short-term return.
Exactly. You need to look at what is the product that suits you. Don't forget, equity as an asset class is risky. You don't have to necessarily make your portfolio more risky by going into these aggressive funds. The second thing which you mentioned about how do you know when to exit. See, if you are investing, let's say at this early stage of your life, there are going to be periods even the best of funds will not perform well. You don't have to panic. See, how do you measure whether your fund is doing very well or not?
Right.
Don't go by absolute return. The problem is when you look at absolute return, we say, okay, it's minus 5%, it hasn't done well. You need to look at relative performance. Every fund has a benchmark. And I think more important is the peer group. So if you're invested in a multi-cap fund which has a bias toward large cap, look at how the rest of the funds have done. Okay, if the benchmark has gone down by 10%, your fund has gone down by 5%, the fund manager has actually delivered returns.
So fair enough. The first thumb rule, 15 to 20% of your monthly income, let's say, should go towards a form of investing if you're 25 to 35. Here's the other question. How much of that should go towards equity? Should you allocate the 100% of that capital towards equity funds? Should you look at balanced funds? Should you also look at an element of, let's say, standalone debt funds? Again, we're talking about a portfolio for someone who's 25 to 35 years old.
Well, I think it clearly depends on your different goals. Okay, now you look at maybe your current income. Okay, saying that, okay, if I maintain the same standard of living, how much would I need? As I mentioned earlier, you need to keep increasing that over a period of time.
Sure.
Then you need to work back and see how much money you need to invest. Maybe you require to invest, let's say, 15,000 per month, and you don't have that much money. So what do? Don't wait for 15,000 to be there for you to start investing. Even if you can spare 5,000, 10,000, start investing. In the meantime, if there are other goals which are short-term and medium-term, could be, for example, you need to create an emergency reserve. All of us must have that. So some money has to go there. What do you do there? There you can look at funds like liquid funds, ultra short-term funds. You cannot be investing money that is required after 6 months or 1 year into equity. At the same time, if you're investing for the long term and you end up investing in these funds, you will underperform. So you need to look at what is your time horizon, goals, and if you don't have enough money to take care of all the goals, that's the time for you to prioritize your goals. Which are the goals which are more important? But I always believe that you must keep an eye on the long-term goals like retirement planning. Fair
enough. So some examples then that perhaps viewers can take away from some sort of funds that you prefer or would like with this category, where people can take on slightly more, an aggressive stance in their equity portfolio.
Well, like I mentioned earlier, I believe that equity is an aggressive asset class. If you're a beginner, make sure they're investing in well-diversified fund. So some of the fund which can be a part of the core portfolio are like you have ICICI Discovery Fund, HDFC Equity Fund, Reliance Equity Opportunity Fund.
And all of these funds have a bias towards large cap?
Some of them will have. If you do a mix of it, you will essentially get a portfolio which is investing, let's say, 60-65% in large cap and the rest in debt. Then you have Kotak Select Focus Fund. So these are 4 or 5 funds where you can begin investing.
Okay, so we'll take a break on that note. We've just gotten started. We'll come back and discuss the next life stage. When you're from 35 to around, let's say, 45, how does your mutual fund portfolio need to change? What should it be geared up for? That and more after the break. Welcome back here with Money, 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 and this week we're in conversation with Mr. Hemant Rustagi to understand the right mutual fund portfolio construct. Mr. Rustagi, so let's talk about the next age category. So now you're a little exposed to the equity market, you're approaching your middle age, so to speak, at around 45. What should your equity portfolio, rather let me not say equity, what should your mutual fund portfolio now contain?
I think again it will depend on whether you started the process early or not. Now if you didn't start early, it's never too late. You need to somehow start planning for it. So if you're someone who hasn't been actually investing money, or if you want to begin investing at this stage, now for your retirement planning you still have some time, but if you're talking about, let's say, building a corpus for children education, you may not have enough time. So that's the time when you need to start looking at hybrid funds. Now what are these hybrid funds? These are the funds which invest in a mix of equity and debt. Now, depending on how much time you have, the bias has to be either for equity or for debt.
So let me actually ask you a counter right here. Is it better to opt for hybrid funds, or is it better to sort of do it yourself, whereas you mix your own, come up with your own cocktail of pure equity funds and then pure debt funds?
If we talk about whether it should be a balanced fund or you kind of mix your own portfolio, see, the advantage here is that when you go into an asset allocation fund or a balanced fund, the fund manager keeps making changes to the allocation. For example, if they capped exposure to equity, the moment it hits that cap, he will kind of reduce exposure to equity and go into debt, which you as an individual investor will find it very, very difficult to do because you will not know when to do. The second is a tax implication. The tax implication on you will come only when you make any transaction. Now, for example, if the fund manager is buying and selling and you continue to hold your investment, you're not paying any tax on that. But if you're having a portfolio of different funds, and if you keep changing every year to rebalance your portfolio,
then there will be a tax liability. There might be.
There might be, if you're doing it for less than 1 year, for example. So, one is the timing, the second is the tax efficiency. That makes sense. But if you're someone who's a well-informed investor, and you are very clear about your asset allocation, and you're not going to really tinker with it over a period of time, you're a disciplined investor, then maybe it makes sense to have a portfolio of different funds rather than going into a hybrid fund. The reason for that is it gives you a variety of different philosophies. You can invest in different funds, the best performing fund or the most consistent fund. Whereas in a hybrid fund, what happens is you are stuck with one fund manager, maybe 2 fund managers.
And you have to trust his or her opinion.
Exactly. And if they go wrong somewhere in the call, then a significant part of your portfolio does not perform.
Well, both have their pluses and minuses. It depends on how well you know both the markets, the equity and the debt market. But let me ask you this. When you're talking about types of hybrid funds, you mentioned the asset allocation funds, and I'm guessing that's where, they're called dynamic asset allocation funds. So there's an automatic almost cutoff at a certain level when the equity market is reaching certain highs, perhaps, the allocation changes. Then there are balanced funds as well. where I guess, there is a different mix of equity and debt. Yes. Which type of hybrid fund is right for one?
Well, again, I think the key factor here is your risk profile and time horizon. Now, if you have a time horizon of, let's say, 5-7 years or even more, you can go into a pure balance fund, which is equity-oriented balance fund, where the fund will invest 65% more in equity and the rest in debt. Okay, because the key factor here is how tax efficient your returns are going to be. But it's equally important to make sure that you have that much time horizon to withstand the volatility that comes with it. Now, if you're talking about a time horizon of 3 to 5 years, okay, and depending on whether you're investing lump sum and also systematically. Now, for example, if you want to invest through SIP, if you have a time horizon of 3 years, your average holding period is only 1.5 years, because the last installment is only for 1 month and the first installment is for 3 years. So obviously you don't have that much time. Then you need to look at a hybrid fund which maybe has a mix of equity, arbitrage and debt. And the reason why I'm saying look at this mix is, if the exposure to equity is, let's say, 20-25%, and the rest 40-45% is in arbitrage and the rest in debt, for tax purposes it is still treated as equity fund. Okay. So you have a benefit of long-term capital gain after 1 year, you have benefit of your dividend being tax-free after 1 year. At the same time, you restricted your exposure to to equity from 25 to 30%. So there are a variety of funds depending on what is your time horizon and what kind of risk profile you have. This is the beauty of investing in mutual fund. I mean, whether you have a time horizon of a month, a decade, or few decades, I think there are funds for you.
As long as you're willing to look and pick and choose the right ones. So some examples when we're talking about different hybrid funds, the ones that you like.
Well, look at the balanced fund like we talked about, where equity is 65% or more. You have HDFC Prudence, you have L&T Prudence, you have Tata Balance Fund. These are some of the balance funds which have been doing very well. Then there are other variety of funds we talked about where there's a mix of equity and arbitrage. There is ICICI Balance Advantage, which typically invests around 45% or so in equity, and then 25% or thereabout in arbitrage, and the rest goes into debt. Then there are equity.
But even this arbitrage fund, as you mentioned, is treated like an equity fund from a tax point of view.
From the tax point of view, and they're risk-free.
Right.
Okay. There is no risk.
Exactly. The mention of the word arbitrage sometimes can make people wonder that is it entirely risk-free or not?
It is, because what's happening, the fund manager is not taking any opposite position in the equity. If he's buying in cash market, he's selling in future markets. So he's not taking any risk. He's trying to generate return out of the arbitrage opportunity which are available in these two markets. Okay. Another category of fund is equity savings funds, which has emerged in the last couple of years. Now, these are the funds which typically invest around 20-25% in equity, 40-45% in arbitrage, the rest in debt. So, if you have a time horizon of a couple of years, but you still want to participate in equity, do not want to take much risk, still want tax-efficient return, these are the funds.
So if you could just recap the examples once again for our viewers.
In this category, there are few funds which have been around. There are not many funds actually, but some of these funds have done pretty well. You have Kotak Equity Arbitrage Fund, you have SBI Equity Arbitrage Fund, and you have Reliance Equity Arbitrage Fund. So these are three funds in this category which investors can look at.
All right, we'll take another break at this point, but on the other side, now we're done talking about the Middle Ages. What happens when you are progressing